Welcome back, sir.
Good to be here. The outlook on the market's gotten very positive. It's very simple. More than half the stocks in the S&P 500 now yield more than the 10-year Treasury. And the S&P on average yields more than the 10-year Treasury. Can't have dividend yields just fat and juicy and not have capital be attracted to the market.
It's an interesting point. You know, if we look at the Dow Diamonds, the ETF there for the Dow Jones 30 blue chip stocks, that yields about 5%, just shy of 5%. And as you say, yields couldn't be any lower, particularly on the near term, but also the 10 and 20-year Treasury.
That's correct. I know there's been a flight to quality because of the European situation, which seems to be stabilizing. With their banking crisis over there and the Greek debt restructuring, where the people that hold some of that Greek debt will lose money on the restructuring. But they did get a high yield on the other hand. But going back to the interest rates, and you can buy stocks and you get a higher yield. Earnings are still growing. The world economy has reaccelerated. Exports and imports have picked up. Our trade was very good in July, so that makes everybody revise their GDP. Yes, it's not a perfect economy. We had flat retail sales, some mixed news out there, but the market's ignoring it, and they're looking ahead. And I think what you'll see is a massive year-end rally, and I think you'll also see an incredible quarter-end rally because I don't know if you remember in late June, the market rallied for 9 days out of nowhere, and that was corporate buybacks. And companies continue to issue debt at very low rates and buy their stock back, and that boosts their earnings per share.
Why don't we talk about your latest newsletter edition? You note that equities have overreacted to the European banking crisis. And, Warren Buffett agrees with you. After shoring up GE and Goldman Sachs during the last crisis, he recently invested in Bank of America. Talk about terrible fundamentals. I wouldn't put a penny into Bank of America. What do you and Mr. Buffett see that other investors are missing here, Louis?
Well, first of all, Bank of America and Citigroup are now government-sponsored entities. They were deemed too big to fail. I'm an ex-bank analyst. I worked for the Fed for 4 years. I know more about bank accounting we have time for, and you never see banks in my portfolio since. But I will tell you that Mr. Buffett got a deal none of us can get, which is preferred stock at a very, very favorable rate. Whether it was 6 or 10 or whatever, he got a better deal than everybody else.
With preferred stock, you get first dibs on whatever's left over, so the common stock folks are actually left out in the cold.
Yeah, so in theory, Bank of America would go under, and Mr. Buffett would still get paid and do well on his investment. Yeah, because he's high in that pecking order. I mean, it's very simple what's going on in the banking industry. What it is when you default on your home, which is unfortunate, a lot of people out west or in Florida, the banks will give you a cash for keys deal to vacate your home, but when you get the cash for keys deal, you can't take out your Sub-Zero refrigerator or your Wolf or Viking stove. You got to leave the house. Here in Reno, we have a joke that those Wolf and Viking stoves fit perfectly in the back of the pickup, and somehow they got little legs on them, keep wandering out of home.
Is that why all these foreclosures, they're always sans, refrigerator, oven, and microwave?
That's interesting. That's probably what's going on. We have 11% of the homes in the United States vacant, so then all makes sense now. But going back to if you don't do the cash for keys deal, the deal out west here is to give you 2% mortgage. So in Reno here, we got quite a few people here that have $900,000 mortgages paying 2% interest only, but the home's only worth $400,000. So what the banks are doing is after you default, they give you a workout. And the workout basically helps the bank improve its reserve requirements, because when you take a non-performing loan, make it a performing loan, you lower your reserve requirement, but you didn't fix the problem. You just took a Band-Aid on it. And see, the Fed can never raise rates now. And they've already said they're not going to raise rates for 2 years. And they got 5 doves on the Fed. And since I talked to you last, they've flattened the yield curve further. 3, 2 years Treasury securities are basically next to nothing. They've had the doves go on a little PR campaign. Charles Evans was on CNBC. He's the Chicago Fed president, and he says, let's raise the inflation target to 3, and let's make sure we never raise rates so unemployment falls below 7. People have to realize they're never raising rates, okay? And this is going to be years before they fix the housing mess. You've got the doves on the Fed don't want to raise rates, and plus you got the deficit. I mean, Peter Orszag, who's President Obama's own ex-White House budget director, basically said as soon as rates get to about 2%, the interest on the deficit will be about $900 billion. Not the deficit, just the interest. And right now our government finances the bulk of its deficit, about 60 basis points, 0.6%, and they keep it mostly in bills and notes. And so what's happening is they can't raise rates because it blows up the government. And this is why you see so much question about what's the Fed doing and why their balance sheet's quadrupled, and I can go on and on. So this low interest rate environment is incredibly bullish for stocks long term. And right now, you can jump in, and we put together a high dividend yielding portfolio. Actually, it's free on our website if somebody wants it. And we took 60 stocks that yield more than 3%, ran through cash flow screens and return equity screens. We graded stocks A, B, C, D, F, and we got down to the 9 creme de la creme, and it yields 4.9%. And and you blend the stocks together, it's pretty darn steady.
You also mentioned that the doves remain in control. Does that mean you expect the Fed to pull the trigger on QE3 as soon as next week's FOMC meeting?
I don't think they will. I think they're trying to flatten the yield curve more. I mean, all the quantitative easing did and rescue packages that allowed them to grow their balance sheets. And now that their balance sheet has gone from under $1 trillion to about $3.5 trillion, they're still messing with the yield curve. See, when I worked for the Fed 30 years ago, they only messed with short-term rates. Now they mess with everything. And, the Fed is sometimes 70% of the Treasury auctions. And they seem to be backing off that a bit because there's been a temporary flight to quality during the European crisis. We're still a very liquid market. But the bottom line is I think they have enough money to continue to manipulate things. And so they would only do QE3 if they needed more money. The $3.5 trillion wasn't sufficient. After they rescued the LIBOR markets and the commercial paper market and the distressed mortgage debt market, when they sell all this stuff and they sold a lot of a profit, then they didn't give the money back. It went back. It just made the balance sheet bigger and bigger. And what QE 1 and 2 did, it allowed them to grow the balance sheets further because they were printing money, and they still have that money. And so the economists like to say they're doing QE 2.5 now. So they're still messing with the yield curve. They're still intervening. If you buy a 3-year Treasury, you'd be lucky to get 0.25%. And they're just shoving money to the stock market and shoving money elsewhere. But you can just see the anxiety out there. People that are retired are just I wouldn't say they're freaking out. They're just so frustrated. Well, because they retire, and how do I get a yield? And I'm a gross stock manager. I sell more bonds than stocks, but it's gotten to the point now where stocks yield more than the bonds we put together and sell to the brokerage community. So I feel very, very good right now that the stock market's putting a very good foundation. And I think the most shocking thing we tell people, and they're not going to be raising rates for some time, and which the Fed has, of course, confirmed, is that the other thing we tell people is we might lose the stock market in 5 to 7 years. And when I say that, corporate America was raising about $20 billion a week in the bond market, and now they're pushing it to $60 billion a week some weeks. So they've gone from $1 trillion a year pace to a $3 trillion a year pace. The last I looked, the stock market's only worth $14 trillion. And companies are out there selling debt at 2 and 3%. We had Caterpillar sell debt in China at 1 3/8, and they're borrowing really cheap, and they're buying their stock back. Because internally, if a company earns 12 or 15% return on equity, and just see my average stock earns 26 to 35, and you can borrow at that rate, you just buy your stock back and make sure earnings per share go up. And you see the companies rush at the end of the quarter to do those buybacks. And that's what caused that late June rally, and you're going to get the same thing in the late September.
So essentially, capital stock accumulation, which in turn creates the mirage of increased demand for stocks and for equity prices, whereas in reality, they're just borrowing cheaply and gobbling up their shares.
That's what's going on, and that's like Finance 101. When kids go to college, they learn, do I finance my business with debt or equity? And they basically tell the kids, well, if you're at 5 times earnings, you got fat operating margins, borrow in the bond market. They say if you're at 50 times earnings, you got a cyclical business, sell some stock. So kids in finance have these lines, do I finance my business with debt or equity? And there were guys like Michael Milken used to run around with these Finance 101 charts and tell CFOs that, hey, your company's messed up. What do you mean we're messed up? You got too much stock. Let me sell you some bonds. You can take that cash, buy your stock back, and you'll be worth more for my financial magic. So one of the consequences of record earnings and record low P ratios relative to earnings and you can borrow cheaply is companies are investing in themselves. And it's pretty legit. And, I just came from Texas, and I was reminding everybody yesterday in Texas that a few years ago, the folks on CNBC used to mock this company called TXU. It's a big utility in Texas. Because they were selling bonds, and they kept buying their stock back, issue bond debt and use it to buy their stock back. But then they got bought out by a private equity company. And then it all kind of made sense. So it is pretty legit to do this, okay? Now, if you're losing money and you have negative return equity, you don't want to do this. but a lot of big multinationals are doing this. And, you got CF Industries of fertilizer buying back $1.5 billion, $1.5 billion they announced. Philip Morris is $1.2 billion a quarter. This is for real.
You alluded to quantitative easing 2.5 before, and we certainly see the footprints of the Fed intervening in the Treasury market, a huge spike up in recent weeks and months. Added to the talk of fiscal spending for this jobs plan, sounds like good news for precious metals investors.
Absolutely. I think precious metals are an oasis, but they're getting volatile. I do have mining companies in some of my portfolios. They zig when other things zag. I have things like Nevada Allied Gold. It's a small gold stock. I have Silver Wheaton, a big silver company. But if there's another crisis, they're going to go up. So people just have to realize that stuff moves opposite of the market. And anyway, it's a whether you have 5%, 8%, that kind of stuff. I'll let the investor decide. But I like those investments because they zig when the market zags and helps me reduce volatility.
Exactly. They tend to be negatively correlated with the market. They have the lower betas. One thing you can't help but notice when you punch in a portfolio of the precious metals, the gold and silver stocks, is that gold and silver stocks seem to be emerging as a de facto value sector amid these choppy markets. What do you think?
I think people don't know where to put their money, and they've already driven the Swiss franc to ridiculous heights, and the Swiss central bank has tried to intervene. They've driven the Brazilian real up 90% against the dollar, so now it's more expensive in Sao Paulo than New York City. In fact, we were exporting ethanol to Brazil. The currencies got so out of whack. And there's just this, capital goes to the countries that have the strongest economy, the most stable economies, and the highest rates. And we have a pretty good long-term reputation in the United States, but we don't have the high rates, and our economy isn't as strong as others. So a lot of the capital that used to park itself in the United States is wandering around, and China used to buy a lot of our treasuries. They've sold all the short-term treasuries. And they're buying 20 strategic commodities, so they're behind this. And by the way, it's working out well for them. You're going to see some of the commodity-related investments soften here just a tad because the dollar has had a temporary rally against the euro, but the dollar against emerging markets and things like that it isn't very strong. And so whatever the dollar strength is, it's been mostly confined to the euro here recently. But when the dollar rallies, it puts downward pressure on commodities, and of course, when the dollar slips, commodity prices start to rise. So commodities are a pretty good parking place for a lot of folks. And not only you got gold and platinum and silver up, you got diamonds up dramatically. And Ron Paul was questioning Ben Bernanke, why can't we put our reserves in diamonds? So.
We talked to Dr. Paul here on the show, and he would certainly prefer precious metals, but you're right, almost anything would be preferable to worthless paper bills.
Well, when he nailed the Ben Bernanke in one of the House subcommittee meetings, he was trying to get Bernanke to admit that gold was money. And it used to be money because in the old days you could turn in your Federal Reserve notes and get gold. And, of course, Bernanke wouldn't say it's money because he doesn't want to empty Fort Knox. But he did admit it was an asset. And then it was fun to watch that interaction. I mean, those two knew exactly what they were doing to each other, and it was very entertaining.
As we wrap up, you're looking for a sizable rally, probably into the holiday season. And what's going to spur that rally? Well, companies issuing bonds, low interest rates.
Buying their stock back, higher yields on stocks. The markets tend to firm up during the holidays. A lot of us are happy in the holidays. Maybe it's family and friends. Maybe it's football. Maybe it's better weather. There's year-end pension funding. It will move in a wave pattern. You'll have some earnings downgrades in September you did in June, but then you'll should have a late month-end rally on the buybacks, and then you might stutter step a little in early October, and then the earnings will come out, and they'll be good initially, and then they get a little sloppy. And then as soon as we hit the holiday season, it's basically lock and load time. From Thanksgiving to April is the seasonally strongest time of the year.